All right, let's dive right into this explainer. Today, we're doing a rigorous, data-driven deep dive into the undisputed king of volatility, CME Group. Forget the surface-level narratives you might hear on standard financial news networks. We're going to look under the hood at the raw mechanics of how CME actually monopolizes the monetization of global macro uncertainty.
You've probably heard people casually call futures exchanges casinos, right? Well, that analogy is just flat out wrong. It's a huge retail misconception that CME is simply some place to place a bet on the S&P 500. Think about it. A casino literally creates games out of thin air. CME, on the other hand, organizes risk transfer for exposures that already exist in the real economy and the broader financial system. It's an absolute structural necessity that underpins the global economy you and I interact with every single day.
So what is it really? CME Group is a global risk transfer infrastructure company. It takes uncertainty and turns it into standardized futures, options, clearing, data, and margin services. And here's the kicker. CME doesn't take market views. It honestly doesn't care if interest rates go up or down. It just operates the indispensable toll road where messy bilateral risk is converted into a centrally cleared, tradable security. Layer 1. Mechanics of clearing. The whole derivatives machine operates in 5 very precise steps. First off, you've got to standardize the risk, defining the contract size, the tick size, and the expiration date. Second, you match the buyers and sellers. Third is the absolutely crucial step. CME Clearing steps in and actually clears the trade, literally becoming the buyer to every seller and the seller to every buyer. Fourth, they margin the risk by collecting initial and variation margin. And finally, step 5, they net and offset that risk across correlated positions. Now, why does that final offset step matter so much? Just look at this number, $85 billion. That represents the average daily margin savings for clients in the first quarter of 2026. Capital is incredibly expensive for institutions, so by allowing banks and massive funds to offset related exposures, CME provides massive capital efficiency. This proves that margin efficiency, not just trade execution, is CME's ultimate competitive moat. So, the core point to take away from Layer 1 is this. CME is built entirely on standardized risk transfer. It uses central counterparty mutualization to basically wipe out bilateral credit worries, which results in massive margin and collateral efficiencies for the world's biggest financial players. Let's just let that sink in for a second. Layer 2, the financial engines. The financial acceleration we see during macro volatility is just staggering. Take the baseline year of 2025. CME generated $6.52 billion in total revenue, pulling in a massive $4.23 billion in operating income. But then look at the first quarter of 2026. In a period of really high macro volatility, they hit a run rate of $1.88 billion in a single quarter. This right here is exactly what a high-margin financial infrastructure company looks like when global uncertainty spikes. Breaking down that record 36.2 million average daily volume from Q1 2026, you'll notice a pretty massive imbalance. Interest rates absolutely dominate the ecosystem, making up over 18.6 million contracts. Equity indexes are a distant second. The big takeaway here, product mix dictates revenue quality, and rate volatility is, without a doubt, CME's biggest fundamental driver. Deconstructing that revenue model a bit further, we can actually isolate their different engines. Out of that $1.88 billion in Q1 2026, $1.54 billion came directly from clearing and transaction fees. But definitely do not ignore the market data section. That's $224 million. If you trade or risk manage these products anywhere in the world, you basically have to pay for CME's data. It's the absolute gold standard for global pricing, making it a highly lucrative, sticky, and recurring revenue stream. But here is a metric that Wall Street analysts literally watch like a hawk, 65.2 cents. This is the average rate per contract. You've always got to analyze this yield metric alongside the volume numbers. Why? Well, as volume explodes, but it's entirely driven by much cheaper micro contracts, overall revenue might actually lag. So understanding CME's true earnings power means you have to watch both the top-of-funnel volume and this critical average rate. To summarize the financial engines, CME reached a record 36.2 million average daily volume in Q1 2026, heavily dominated by interest rates. They operate this incredibly high operating leverage model, meaning when volume spikes, profits just soar, and the whole thing is backstopped by that highly sticky market data revenue. Take a second to absorb those metrics. Layer 3, intrinsic value drivers. You know, network effects compound over time, and CME's moat certainly didn't appear overnight. It actually started way back in 1898 with agricultural risk transfer in Chicago. Fast forward to the 1970s, and they pioneered financial futures. The 90s brought us electronic trading via Globex. The 2000s saw mega mergers with the Board of Trade and NYMEX. And now, by 2026, it is a massive, highly integrated global data and clearing ecosystem. This long, historical accumulation of liquidity means their benchmark contracts are practically impossible for competitors to disrupt. So, what actually fuels this volatility flywheel? It's essentially a cyclical, self-reinforcing engine. Macro uncertainty creates an immediate need for trading. All that trading deepens the liquidity pool. Deep liquidity then improves margin offsets because there are just more offsetting positions available in the system. And that resulting capital efficiency cements CME's benchmark's dominance, which brings in even more hedgers and speculators the next time uncertainty strikes. And options convexity? That just accelerates this entire loop. Of course, we have to keep it objective and weigh these structural drivers against the inherent risks. The drivers are incredibly strong. You've got benchmark dominance, absolute institutional trust in their clearinghouse, and massive international growth, hitting 11.4 million volume outside the US in Q1 2026 alone. But the risks are very real. The kryptonite of the volatility king? Quiet markets. Prolonged low volatility environments suppress that core transaction engine. Other risks include catastrophic clearinghouse failures or heavy regulatory pressure. To cap off layer 3, liquidity begets liquidity. Options convexity and cross-margining really secure that institutional trust, but prolonged periods of low volatility remain their primary cyclical threat. Take a quick moment to reflect on these dynamics. Bringing it all together for our final section, the ultimate volatility toll road. This final quote captures the whole story perfectly. The world produces volatility. CME industrializes it. CME isn't just a regular exchange. It is the infrastructure of uncertainty itself. It's the place where the global economy's unavoidable chaos is converted into standardized, liquid, and margin-efficient contracts. So the next time global markets panic and the VIX spikes, ask yourself, are you just reacting to the chaos, or are you looking at the toll road that's quietly cashing in on it?